For traders that have emailed and asked, the links for the free downloads are in the description box below. Just click on the link or copy and paste and put that in your browser. The 4-step method to high performance trading and the 7-step daily routine for high performance traders create the rituals, the mindset, and the winning attitude to master the markets. Bulletproof yourself with your daily routine and your habits. Force yourself to be getting better, 1% better every single day. How good can you get, traders? Again, the free downloads, the links are down below. They're both free courses. Let's get started. Here's Stacey Burke from Stacey Burke Trading. Today we're going to be reviewing the day count and identifying your best trade setups. Quite a few questions the last few days regarding certain trades and certain instruments. And could I review gold? Could I review the S&P? US 30, I don't trade US 30, but we can look at that. But more importantly, I keep reinforcing some simple concepts. The sessions, the 3 levels of rise or fall, that can be 3 weeks, that can be 3 days, that can be 3 sessions, and in some cases it can be 3 hours. So you need to put your thesis together each session for the opportunity. Now I talk about being biased to the short side, so often I will be looking at instruments that are at the high of the day or perhaps the high of the session if it's heading into the New York Open, for example, after news, and we can still get 3 levels of rise in a broken down market if I'm shorting, and the same applies for trend trades, short squeezes, reversal trades, so we'll look at a couple of scenarios. But if you understand the day count in terms of day 1, day 2, day 3, the simplest thing to understand is the stair step. Day 1, day 2, day 3, we can see a break in structure and a reversal possibility. Now it doesn't always have to play out like this. Obviously we can get day 1, but what we talk about is Monday, Tuesday often will set the high and the low for the week. So we can get a Monday, Tuesday, Wednesday for a move down. Again, initial balance. The first 2 days will establish the high and low potentially of the week, and one of those extremes will tend to hold. That will coincide with the overall existing timing of the market. So we have our monthly cycle, week 1, week 2, week 3. We'll look at some examples of that. And we can have a day 1 that sets a high on a Monday and a creeping trend down on a Tuesday for a day 2, level 2 trend day, which I've talked about before. Day 2, level 2 trend day. Day 3, we can work the high for a reversal trade on higher level longs. So if you understand the day count and you can see a possible trade setup, whether that be for a high of the day trade, or we can get a short squeeze. First hour makes a high and a low, second hour opens up, takes traders into the low, we get a break in structure for a third hour trade. Short squeeze, and our lower quarter is the trapped volume. So we have level 1, level 2, level 3, level 4. We talked about this last day. Level 4 and level 1. So a great question from a trader is that, well, what if the market has dropped 4 levels? So we obviously have dropped possibly 100 pips, and what you need to understand is that often that lower level is level 1, but that peak formation is where the trap volume is, where they reverse. So the next level up becomes our level 1. They can come up to the 75-100 level for a reversal trade opportunity, depending on the timings and if there's any news on the calendar. So the other scenario that we can look at where traders can get stuck is that the market comes down into level 1 at the low of the day, and traders are looking for a reversal trade down at that level 1, but the market is actually putting peak formations in for a continuation trade. Now, one of the questions that traders have asked me is, how do you know when there's a continuation trade versus a reversal trade. Now that comes back again to our day 1, day 2, day 3. If our initial balance, we have peak formations on the upside, that's where we potentially may see a measured move down for a continuation trade. What will matter the most about all of this is the timing of everything. It's the timing. So for example, if we were to see a market making lower lows, creeping into the double zeros, and maybe even breaking structure on the bottom side as the London market opens, that first hour, for example, we've talked about the first hour will often make a high and a low. If the second hour, the equity hour, London or New York, our trend is down, if they are reversing, that's the hour where the market is pulling back against the trend. So we have first hour, second hour is the counter trend. The equity market takes traders in the opposite direction. Traders are looking for the reversal and trading in the actual counter trend move, which creates the order flow for the move down, a 1, 2, 3, 1 hour, 2 hours, 3 hours, the same as our day count, day 1, day 2, day 3. Now I know there's traders out there who continue to fight and argue with themselves about what it is, but remember what I am doing. I am looking for setups. I don't care what the thesis of commitments of traders and all that and everything else, and what the VIX is or the indicators or anything. I'm looking for setups in those timing windows. So some days you're going to get a high of the week trade on day 2 in Asia for a reversal. They're going to bring it up at the end of the US session. They might pull it back in London and roll it over, or they might pull it back in London and continue that up on day 2. Day 2 continues to go higher. We get a 25 pip pullback on day 2, and guess what? They take you higher on day 3, but look at where we're getting trapped volume higher and higher and higher. Let's look at some specific examples. So again, I want to reinforce that a lot of traders are doing battle with themselves. They think they're looking for setups, but what they're doing is actually going to the screen trying to trade moves, and you don't have a setup. So remember that. You need if you're trying to trade a move because you're at the low or the high, that's where you're actually getting caught in the wrong directions, because you do not have a setup. The setup is, you need to align that with an actual playbook setup that you have, where that's a trade setup, not where it's at the low of the day I'm going long and then finding out that you're counter trending, or at the high of the day and going short, only to find out that they're going to go another 25 or 50 pips into you because you're in a trend trade. So if we take a look at the Canadian dollar, we just go back, just take a step back. Okay, we've talked about this. First week came down. Again, we'll look at any instrument you want to look at. The very beginning of the month goes down and puts a low of the month in place. So remember what happens when they go down. We have shorts in the market at the low of the month. This is coming back to where we're at now, not hindsight trading. We're looking at what's happened so that we can form our thesis. All of this volume is caught at the low of the month. And then what happens? We have our week 1. Okay, week 1. Why is it week 1? Because we have longs in the market at the close of the week at breaking the previous week's high. We've got longs in the market. That's week 1. We go up the second week, taking out the high of week 1. So now we have week 2 longs in the market. Okay, so when they break out on Monday, Tuesday, we have week 2 is made new higher highs. So the longs are in the market. Now we have traders then who had high of the day opportunities, broken down market on day 2, day 3, high of the day short, but they go down on Thursday, the day 4, and put a peak formation low in and get traders shorting into the low. And again, you'll notice our 100 pip box, we're down at level 1 for the buy low. Even with news, it's a buy low opportunity. They're trapping volume down. And how many levels do we have? So forget about the actual specific count, but just look at the big picture. 50, 50, and 50. That's 3 levels of 50 down to the low of the week, low of the day, low of the session on Friday for the explosive reversal back up. Closing the week now, closing the week as a green week. Okay, it opened, closed above where it opened, and now we have week 3 longs in the market. Week 3 longs. Why is that? Because we broke out of the previous week's high. So breakout traders immediately get 75 pips put into them. So traders that are long, we had obviously high of the day shorts in the London session. If you're not sure, if you can't see the specific enough, this is the Canadian dollar. So open up your charts, go back through and walk yourself through the process so that you actually know what you're seeing. But they come down, and day two put a peak formation low in place, which was the continuation long trade in the U.S. session for a vertical 175 to 100 pip move straight back up through the high of the week. We're in an up market, week 1, week 2, week 3. So now we have day 3 longs. We'll just zoom this over. Day 3 longs. Okay, we've taken out the high of day 2. Day 3 longs into the U.S. session. 1 push, 2 pushes, 3 pushes to the high, but notice the numbers. We're 25 pips above the 00 box. High of the day, 3rd hour short for a 50 pip move back into longs from the London session. I've talked about this before. Day 2, your odds of a reversal trade opportunity increase, except that we had the trend trade on day 2. So repeat after me. Day 2, level 2. That's the trend day. If you're going long, you're down low coming long. If it's a reversal trade, you'll have already taken out the high, and you'll have a high of the day trade opportunity on day 2 where your odds increase 70 to 80% of having a successful counter trend or reversal trade at the high of the day on day 2. Day 1 on Monday was a high of the week formation for a low-hanging fruit trade as opposed to a day 1 runner. Day 1 runner, we'll look at an example of that. I believe the euro was a great example. So today, 3rd hour trade, high of the day, 25 pips above the 100 pip box for the 50 pip reversal trade back into longs from the open of the Europe session. So coming back day 1, day 2, day 3. So if you have an instrument that you're trying to trade because you're just focusing on 1 or 2 instruments and trying to look for the trades as opposed to looking for what is the best setup on the instrument in the session that I'm trading. If you're looking for shorts, I want to see obviously day 1, day 2, day 3, I'm looking for high of the day opportunities, or if it's a trend trade, obviously a continuation trade coming out of the peak formation low on day 2 back to the high of the week for U.S. session. Okay, so we've had textbook perfect trades. Peak formation low on the Friday, day 1 Monday, day 2 trend day. Okay, so think in simple terms. Day 2, if it's a trend trade, should be continuing that existing initial breakout or move on from day 1. Day 1, day 2, day 3. It's the stairs that we talk about. We get to the high of the week, high of the day, U.S. session after the news, New York Open, 00s for a 50 pip reversal down into traders that were long in the Europe window. So going back through your instruments will help you understand this. Euro, day 1 runner on Monday, day 1. Okay, we had a 25 pip reversal end of the 3-hour window, but day 2 continues to go higher. Day 2, level 2, right? We break the high, we trigger longs. So every time longs get triggered, they're being forced to buy higher. They come, breakout traders are triggered into the market, and again, notice our 00s. We're moving up into the peak formation from Friday. We're 50 pips above the box. This 00 area now may act as a support area, and the 50 can act as resistance. But we had a sell high opportunity, day 3, high of the day, into the U.S. session high for a 50 pip short trade, high of the day in London on day 3. one push, two push, three pushes into the low of the day as well as the previous day's low. We had news, 8:15, non-farm ADP, and then the New York equity market open, double zeros for a 75 pip continuation long on day 3. So we have day 3 longs still in the market. Again, breakout traders. So we'll have to obviously observe what happens tomorrow. On Thursday, we could still have a reversal opportunity at some point for a fairly large move down. We've got day 3 longs in the market. They've put in a peak formation low, so double zeros. This 1,000 is major round number level that could act as support also. But day 1, day 2, day 3, we had trend trade opportunities in the U.S. session. We had reversal high of the day opportunities in London, reversal in the U.S. session, trend trade continuation in the London session yesterday, so 50 pips with the trend, 25 to 40 roughly, reversal trade in the U.S. session, which is a stop hunt, obviously, into the traders that were long in the London session. Now, I talked about this before with the indexes, S&P and NASDAQ. I use major quarter levels. So, again, for traders who they've asked about my sweet spot settings. Okay, so for my big picture hypothesis on these indexes, I just add a 0. Okay, I add a 0 on my sweet spots indicator. And we'll talk about going down to the 1 minute, which is basically subtracting a 0. But you'll notice, and I talked about this in previous videos, these indexes respect major quarter levels. I repeat, the indexes respect major quarter levels. Double zeros, 250 pip boxes, 500, and the previous day's highs and lows. So essentially you have an opportunity, and I'm only trading the U.S. session on these pairs. But that means when I go down to a smaller time frame, so we look before the session even starts, before the U.S. session even starts, I have a low of the day, which is just above the quarter level, and I have my major double zeros, triple zeros, whatever you want to call it, the 4,000 level, and I have the high of the London session and the high of the day. And for simplicity, I just typically draw the high of the day, the high of the session, prior to going into the window. That's it. Those are my 3 lines, and then I'm on day 1, day 2, day 3. Now you'll notice we had a very large move down, which coming back to looking back at the previous week, I mean, this was an absolute gift. If you want to learn something about day 1, day 2, day 3, the escalator and the elevator, you know, I've had people message me and ask me about commitments of traders reports, the central bank, the interest rates, all that stuff, and I've repeated this. I don't care what anybody else says or what they think. I don't engage in any of that. I look at the charts. I have a thesis. I follow each pair. I have notes on those instruments. Day 1, day 2, day 3. Is it moving up or moving down? Obviously, I look at pairs that are moving up because I like to short things. Day 1 on the previous Monday. I'll just bring up my weekly separator. Day 1, day 2, day 3. And, you know, this is a 1,000 pip box. A 1,000 pip box. So the market came down on the Monday and put in a low, and I said this before again, when they reverse on a Wednesday, you can still get a day 1, day 2, day 3. Wednesday forms the low. Thursday obviously is day 2 on the day count for the trade setup. Monday is always my first day. Everything starts on a Monday. So we go day 1, day 2, day 3. We're in a 1,000 pip box. We had the massive move down, 2,000 pips almost, into the lower 1,000 pip box. Okay. And then we go day 1, and we have, this is first red day, by the way, was Friday, first red day. And then we have 3 levels of rise, 250, 500, and 750. We're in the 3rd level of rise at the previous day's high for the continuation trade short. And if you study L. Brooks, this is our H1 setup in a strong downward market. So we have a downward market where day 3, the market takes out the, instead of taking out the low of the day on day 3 and triggering day 3 shorts, we form 3 peaks coming back up into the open of the London window. and we have our high and our low rectangle in a 500 pip box. Okay, so when I come to the screen before the session opens, okay, so before we come into this hour before, it's very straightforward. I have peak formations up at 50. This is the S&P. And I've got peak formations down at 00, which form my low and high range. Now you'll notice how many levels. If these are peak formation highs and we look at our 00 boxes, so we have 100, 100, and 100. That's 3 levels of drop. But prior to our open of the session, the market moves up from our triple bottom formation below 50. This is before news, before ADP at 8:15 New York time. The market proceeds to climb 2 levels before coming back, continuing in that US session window, and we proceed to auction up 3 levels of rise into the middle open of the middle hour for a 200 pip reversal off of the 3rd level of rise into the peak formation of this trade. So for traders who are out there and they're going to post something, oh, this is hindsight and everything else, I want you to repeat after me. 1, 2, 3. 3 levels of rise, 2nd hour equity session, our micro M formation for the explosive move down through all these higher level longs. Now we have the stop hunt and then the New York Open reversing back up to the high of the day. So think about that. Equity market opens and goes up to the high of the day. That's a 15-minute move at the open of the New York session, the equity market open, back to the high of the day. So we've had opportunities at the open of that 2nd hour. The market opens up, proceeds to auction back to the high, and now I want you to repeat after me again. 1 push, 2 pushes, 3 pushes at 00s at the high of the day into the peak formations on the 3rd level of rise for a reversal trend back down to the low of that middle hour. So again, whenever you notice two-sided price action, that's a creeping trend. The market could be coiling for a reversal. And for me, I'm not interested in trying to squeeze out every last pip. I'm going to take the money and get off the screen. Oil, same thing. We have our day 1 on Monday. So the market forms a great consolidation, a 100 pip box in Asia and in London. Put both these in for the day 2 trend trade in the US session. So again, peak formation low on Friday. Okay, peak formation low. Day 2, level 2 trend day. Day 3, high of the day, high of the week. Traders at the London Open have the opportunity to sell the high of the week in the London session. Okay, count the levels of rise. 100, 200, 300 pips, 3 levels of rise. Day 2, high of the day, high of the week. London for a massive short trade all the way back down to day 1, low of the week, low of Friday. So day 1, day 2, day 3, reversal high of the day, the 1, 2, 3 in the U.S. session. So for traders who have asked, what about continuations? We're in a market that's already broken down like that. Peak formation. I need a peak formation. This is a 100 pip peak formation. Stop on into the existing trend. Let's bring this back. Zoom in a bit for traders. We get the 1, 2, sideways 3. So just do the math. That's 1 hour up. Beginning of the U.S. session. The reversal 2nd hour. 3 levels up. 00s 25, 50, 75. Reversal New York Open. Continuation down. Okay, so you need to be looking at this. Who's caught? I'll tell you who's caught. Underneath this day 1. Day 1, they're going after the money. You've heard me say this over and over again. Peak formation low on day 2, creeping trend up, 100 pip box, 25 to 50 pips into, okay, start paying attention to where the peak formations are. Okay, peak formation, U.S. session on the way down. We get a peak formation into the lower level shorts, and then the continuation in the London session. So we've got our lower level shorts heading into the U.S. session down at the bottom of the week on day 3. They auction into the third level. So again, traders have said, well, we had 4 levels of drop. When the market has consolidation and it breaks down like that and we get a large volatility instrument, oil, gold indexes, it's all about the timing window. So we've come down 400 pips before the U.S. session opens with a large engulfment, and then 1 push, 2 pushes, 3 pushes into that peak formation low. For the long trade after the news, back up towards traders again, study and understand who is in the money. If you start to see that again, and then you're looking at what day it is, what level are we on, are we down low, are we up high, you can see who's in the money. Now we got our shorts, the peak formation low, we're on day 3 at the low of the week, the low of the month, this is the last day of the month, and then 1 push, 2 push, 3 pushes as we head into the U.S. session after non-farm ADP. Not to say this is perfect, but there was a 100 pip explosive move that went vertical for the parabolic move into traders who are on the lower level shorts. So gold, study gold. Again, go back, understand the days of the week. We'll put our weekly separator in here. Okay, day 1 took out the low of the week. So immediately when we see that happen and the market puts in a peak formation low, okay, just understand that they took out the high of the day, went into double zeros. It was an inside day on day 2, inside day 2 in a broken down market, breaking down, and we'll explain that in a second. But the initial shorts get caught down low, trading Europe, London, Asia, whatever, breakout traders, whatever that may be, and they put 100 pips plus 200 pips into those traders that are short, but they break out of the high of the day. They break out of the high of the day, and this becomes a peak formation high. So we can put peak formation high on the upside because we have day 2. We have day 2 now inside. Now you'll notice on day 2, some traders got caught trying to counter trend this. They're inside. They're inside. The market breaks down through the low of the London session. That's a breakout. That's a breakout now of that higher level low. Okay, so they've split the box. Peak formations are up inside of that breakdown. Peak formations are up, and I've said this, you've heard me say this, when the market goes sideways inside of a low or a high, it's coiling for an explosive move. Do you notice they don't trigger the low of day 1 until after they put in a peak formation high right prior to the Europe Open window? So these are things that you need to be looking at. We have day 1. Day 2 is an inside day. It's an inside day. They just tap it. That's not enough, though, to trigger other time frame traders because we're inside of the low of the week. Peak formation high into the peak formation high. On the way down, a peak formation. That's our new high of the day in the U.S. session. They don't break that. They trade back up into it at 50 and break down in the London session for a 100 pip move down through the low of the week. Day 1, day 2, day 3. We have inside bar traders short now. They put in the double bottom for the explosive 75 pip move back up, which several traders took this short squeeze today in the New York Open, myself included. But I received emails. This was an ideal opportunity for an explosive move. 1 hour down, second hour trades back into the low. Peak formation high on non-farm ADP. Okay, we have a low already in at double zeros on day 3. 1 hour goes by and they do not break through the low. But do you notice where volume is getting trapped? Volume is getting trapped in the lower quarter. The volume's trapped in the lower quarter. 30 to 45 minutes in that second hour for the engulfment and the explosive move back up. 1 push, 2 push, 3 pushes for the continuation. When you see this on day 3, you need to understand that they are not coming back down. on this type of situation. All this volume is trapped underneath of 50. If they come back below there, they're allowing traders who are now underwater or who haven't been stopped out or who are holding on, averaging in, whatever they may be doing, or trying to counter trend this. They're not going to come back down because it allows them to get out of a losing position. The continuation trade follows back up because why? Day 3, we have traders that are in the money in that London session up at double zeros. So critical to understand who's in the money. Don't counter trend. You're down low on day 3. They're not coming back down because that allows all this lower volume to get out of a losing trade. So you need to understand what your setups are. Keep it simple. If you don't see a setup, don't try to figure out and be a super smart trader and trade the moves. I know there's traders out there, they message me stuff. They got so much. Stick to one thing. Pick one thing, get good at it. Don't, spread yourself all over the place and get all these other ideas in your head, and it's about setups, scalable setups. Whoever traded London today made a killing. Whoever traded the U.S. today had an opportunity to make a killing. We had opportunities in the long direction. We had opportunities in the short direction. We had trend trades yesterday. We've had trend trades today, day 3. We've had level 1 trades on Monday. Great opportunities on gold alone. Asia shorts, U.S. session longs, 100 pips in both sessions. At least 50 to 75 of locked-in profitable trade setups in the 12-candle windows. So know what you're looking for. It's not about trying to trade every session or every move or the movements. It's about knowing what you're looking for in the session that you're trading, knowing when you can scale in with size. Okay, we talked about first red day, first green day. Level 3 trades. They're the ones that I size into. They're the ones that have the opportunity to go large moves. So keep it simple. Master your setups. Master the day count. Then the session trades make sense. Whether it's a trend trade, a reversal trade, a scalp, a sizable trade, whatever that may be. You need to build your playbook. You need to master those setups. Keep it simple, traders. We've had just opportunities day after day after day. Keep it simple. Get better at them. 1% better every single day. Master the markets. Master yourself. And may the markets go with you.